Let me ask you something important. The biggest financial disaster of 2025 already started. Would you even notice it? Because here is the uncomfortable truth. Every major financial collapse in history was obvious only after it happened. For that, it looked like stability. It looked like control. It looked like nothing was wrong. Right now, markets are calm. Jobs still exist. The system is still moving. And that is exactly why this moment is dangerous. Not because something is breaking, but because nothing is forcing change. In this video, we are not going to talk about a crash. We're going to talk about something far more destructive: delay. A slow financial drift that locks in losses quietly reshapes lives without headlines, and leaves people wondering years later how they fell behind without a single dramatic moment. At the end of this video, you will understand why waiting for a crash may be the biggest mistake of 2025, and why the calm you see today could be the warning sign everyone is ignoring. Setting the stage. How systems hide problems. To understand why delay is dangerous, we first need to understand how modern financial systems actually behave. Markets are not built to warn people early. They are built to absorb stress quietly. When pressure rises, central banks step in to smooth volatility. Governments stretch timelines instead of forcing resolution. Corporations refinance debt instead of failing. From the outside, this looks like control. But what it really creates is insulation. Problems do not disappear. They simply stop making noise. In earlier eras, financial stress surfaced quickly. A failed harvest could trigger famine. Banking failure could collapse credit. A currency shock could wipe out savings overnight. Pain was immediate and impossible to ignore. Modern systems work differently. Today, stress is stretched across years instead of weeks. Losses are socialized instead of concentrated. Debt is rolled forward instead of written off. Signals that once warned people are muted. This is why danger no longer announces itself loudly. This did not begin in 2025. It began decades ago. After the Great Depression, policymakers reached a powerful conclusion. Volatility itself was the enemy. Stability became the goal at any cost. What few people acknowledged was that stability also has a price, and that price is delay. Origins. When delay became policy, the culture of delay took shape in the late 20th century. During the 1980s and 1990s, finance changed faster than regulation. Derivatives expanded rapidly. Capital moved globally at unprecedented speed. Banking structures became layered and complex. Complexity created efficiency, but it also created fragility. Instead of allowing systems to reset through failure, authorities chose intervention. Interest rates were lowered. Liquidity was injected. Losses were postponed. At first, it looked like success. Each crisis that did not fully collapse the system reinforced the same lesson. Delay works. Markets stabilized. Confidence returned. Growth resumed. But delay does not eliminate risk. It relocates it. Risk moved forward in time, and each postponement made the eventual cost harder to see. The rise. How delay became invisible by the early 2000s. Delay was no longer treated as an emergency response. It became standard practice. Debt levels climbed steadily. Asset prices rose faster than income. Productivity growth slowed, yet nothing appeared broken. Then the global financial crisis arrived. Banks failed. Credit froze. Fear returned to markets. For a moment, delay seemed impossible. But once again, the response followed the same pattern. Interest rates fell to zero. Central bank balance sheets expanded dramatically. Emergency measures became permanent tools. The crash ended, but the distortions did not. Bad debt was not cleared. It was refinanced. Broken incentives were not fixed. They were stabilized. And over time, stability itself became the signal that everything was fine. The breaking point that never came after 2008, many expected a reckoning. They waited for excesses to unwind, for leverage to shrink, for systems to reset. That moment never arrived. Markets recovered faster than the real economy. Wealth concentrated upward. Wage growth lagged behind asset inflation. Then another shock arrived, a global pandemic. Once again, intervention followed. Larger than before, faster than ever. What should have forced change became another extension. This created a dangerous belief. If the system survived that, it can survive anything. That belief is what makes delay so powerful and so dangerous. Fallout. The cost of waiting delay rarely feels like damage. It feels like patience, like caution, like responsible management. But the costs accumulate quietly. Inflation erodes purchasing power slowly. Housing becomes less affordable year by year. Debt servicing turns from an exception into a permanent condition. People adjust without realizing what they are giving up. A generation resets expectations downward. Later retirement becomes normal. Higher rent feels unavoidable. Security feels optional. No single moment triggers panic, because no single moment looks catastrophic. That is the trap. Failed fixes. Why solutions stop working? Policymakers still reach for familiar tools. Interest rate adjustments, fiscal stimulus, regulatory tweaks. But these tools were built for shocks, not for prolonged delay. Each intervention now delivers less impact than before. Higher rates strain debt-heavy systems. Lower rates inflate asset prices further. Spending programs expand deficits without correcting structure. The system does not collapse, it stagnates. And stagnation is far harder to recognize than crisis. Modern parallels. Why 2025 is different. In 2025, the warning signs are subtle but consistent. Growth exists, but it is uneven. Markets are elevated, but participation is narrow. Employment appears strong, but mobility is weak. History shows that prolonged delay leads to one of two outcomes: either a slow erosion of living standards or a sharp correction once trust finally breaks. The real danger is not misdimming the crash. It is mistaking stability for safety. Societies that delayed reform rarely collapsed overnight. They declined quietly. The pattern, what keeps repeating every delayed crisis, follows the same sequence. Intervention prevents immediate pain. Normalization removes urgency. Structural problems harden over time. By the moment action becomes unavoidable, options are limited. The system appears calm, right up until flexibility disappears. That is the real risk of 2025. Not panic, not headlines, but inertia. 3 clear takeaways. Takeaway 1. The absence of a crash does not mean the absence of risk. Stability can hide deeper imbalances. Takeaway 2. Delay transfers cost to the future. The longer the delay, the fewer choices remain. Takeaway 3. Understanding systems matters more than predicting events. Those who wait for visible danger often react too late. Final warning and call to action. History does not repeat through disasters alone. It repeats through complacency. The most dangerous financial periods are the ones that feel manageable, the ones where nothing forces immediate change. 2025 may not be remembered for a crash. It may be remembered for what did not happen, for what was allowed to continue. If you want deeper breakdowns of the shifts most people overlook, subscribe to the channel. Because the real risk is not missing the crash. It is misunderstanding the calm.